If you needed money to replace a blown-out tire or to repair a leak in the roof, or even if you just lacked $100 for a $1,000 vacation trip, you would probably go into debt for the amount you needed. You wouldn't and probably couldn't borrow $100,000 for a Ferrari convertible if you didn't have enough income to buy your groceries. But there are times when borrowing is proper. What do you go into when you borrow money? Of course. You've been familiar with debt all your life. Most homes and automobiles are bought with loans. Merchants often try to increase sales by offering credit to consumers. And finance companies urge consumers to consolidate their debts by taking out one big loan. An important part of personal financial planning and budgeting is making sure you have money when you need it. One way, as you have found, is to put off expenditures if you can. What is another way? Yes. If you haven't done much borrowing, you're probably not sure about the best place and the best way to make consumer loans. Making these difficult decisions is easier than it used to be due to the Consumer Protection Act, often called the Truth in Lending Act. This act requires lenders to state the conditions of the loan, including the charge you pay for borrowing. The use of money is worth money. If you borrow from your friends or parents for a little while, you just pay back the principal, the amount you borrowed. But if you borrow from a bank or other professional lender, you pay back the principal plus a percentage of the principal. What is this additional charge called? Right. The total amount of interest you pay equals the principal times the rate of interest times the number of years. If you borrow $1,000 at 12% interest for 2 years, what is the interest? Yes. But the rate of interest can be calculated in various ways, and you need to know when you are actually paying a higher rate. You probably already know about simple and compound interest on savings and realize that 12% compound interest gives you more money than 12% simple interest. With loans, you pay a higher interest at 12% compound than at 12% simple, so you need to know the difference between them. If you borrow $1,000 for 1 year at 12% interest and repay $1,120 in a single payment at the end of the year, what kind of interest are you paying? Right. With this single payment loan, you pay 12% simple interest per year, or 1% per month on the principal, and you owe the entire $1,000 principal for the whole year. But what happens when you make monthly payments on the loan? For how many months do you owe the whole $1,000 principal? Yes. When you make the first payment at the end of the first month, you pay back part of the principal. Each month you pay back another part of the principal, so during the year you owe an average of about 1/2 of the $1,000 principal. If you take out an installment loan at 12% installment or add-on interest, the lender adds $120 to $1,000 and divides the total into 12 equal payments of $93.33. Each month you pay $83.33 on the principal and 1% of $1,000 in interest. How much is your monthly interest? Right. You pay 1% of $1,000 in interest every month, but you owe an average of about $500 in principal during the year. So each month, you pay a higher percentage of interest on the principal you actually owe. The first month, you pay interest equal to 1% of the principal you owe, but by the 12th month, you pay 12% of the principal you owe. You are actually paying an annual percentage rate, APR, of about 21.5% on the amount of principal you owe instead of 12%. If you had an installment loan for $1,000 at 12% APR on the principal owed, your total interest would be $66.20 instead of $120. You would pay interest each month equal to 1% of the principal you owed, not the principal you borrowed. If a used car salesman said you could finance $2,000 on his old Falcon for 2 years at 10% add-on, or $400 interest for the 2 years, about what APR would you be paying? Yes. The Truth in Lending Act requires a lender to disclose the APR on a loan. But you can calculate the approximate APR on an installment loan by multiplying the interest by 24 and then dividing by the principal borrowed times the number of payments plus 1. If you buy the old Falcon with a 2-year installment loan for $2,000 and pay $400 interest, the formula for the approximate APR gives you 400 times 24 divided by 2,000 times 25. About what is the APR? Right. But as we saw earlier, it's really an APR of about 18%. Although the simple formula is more accurate for lower APRs, this more complicated formula is more accurate for monthly payments with higher APRs. APR equals interest times the quantity 9 plus 95 times the number of loan payments divided by the quantity interest plus 4 times the principal, and also divided by the number of payments times the quantity 1. Using this longer formula, we get about 18.16% APR, which is very close. The monthly payment on that $2,000 loan is about $100. The average monthly percentage of interest is approximately what? That's right. Using the 24I divided by P times N plus 1 formula, about what is the APR on a $1,000 12-month loan with $100 interest? It looks like 2,400 divided by 13,000. Yes. Actually, the APR is closer to 18% using the longer formula. Here are the two formulas again. Another source of confusion, besides simple and compound interest, is discount. If you borrow $1,000 for a year and repay it in one payment, interest of, say, 15% is subtracted at the time of the loan. You get $850 and pay $1,000. Is this 15% APR? Right, you only have the use of $850 and paid $150 for the use of it. Since this is not an installment loan, you use the I equals PRT formula. $150 is 17.65% of $850, and that's what the Truth in Lending Act would require to be disclosed. Interest rates, of course, mostly reflect the supply and demand of money. In times of high inflation, rates are high because they must include the fact that loans will be repaid with cheaper dollars. If you pay 15% interest, but annual inflation is 10%, what's the real interest return to the lender? Right. At one time in 1981, the prime rate was more than 20%. Inflation was about half of that. Long-term, real interest rates, after inflation, have usually been about 3 to 6%. You may have never paid nominal interest that low, especially if you're young. And if your loans were considered risky or were small, and with a local personal finance company rather than a bank, they were probably at high rates. It's more expensive per dollar of interest earned for a lender to manage small loans. The risk of loss is greater. Would you expect the interest rates on small loans to be high or low? In many states, there have been usury laws limiting maximum interest. Usury means excessive interest rates. But to limit interest rates unreasonably often means eliminating loans to the poorest risks, except by often brutal loan sharks. There are times when it seems we would pay anything for a small short-term loan just to get by some present crisis. But you should try to do what? Of course. Most consumer or personal loans are made to finance the purchase of a car, a home, or furnishings, and the purchased property is used as collateral or security to ensure that the loan is repaid. When an installment loan is part of a sales contract, what would you think they are? Right. What is the name of the actual piece of paper which contains the formal promise of the borrower to pay the money as specified by dates and amounts? Yes. The sales contract is written to record the details of the purchase, including the names of buyer and seller, the merchandise, down payment, installments, and all fees and charges. The collateral or security agreement sets up a lien, which gives the lender the right to sell the collateral if the borrower does not pay. A copy of this lien is filed with the local courthouse or similar facility to make the agreement public knowledge. And, in addition, there is usually, especially for cars, an agreement that insurance on the property will be arranged by the buyer and borrower. In fact, the seller often will arrange for this insurance at the time of the sale, although you may generally arrange it through your own insurance agent. In the next program, you will learn more about consumer credit and borrowing, about establishing a good credit rating, and about several credit laws protecting consumers. If you wish to buy something and enjoy it while you pay for it in installments, you must agree not only to the interest amount, but to several loan features. Whom do these features mainly protect? Of course. The borrower should be protected by good sense and the provisions of the Truth in Lending Act and other laws. Which of these describes a likely consumer loan? Yes. Using this simple formula, what is the approximate annual percentage rate of a $500 loan to be repaid in 10 monthly installments of $54? Yes. It's actually close to 17%. If you paid 18% APR on a $1,000 two-year monthly installment loan with $50 payments, about how much of the first month's payment do you think would apply to the principal? Right. $18 APR is 1.5% per month. 1.5% of $1,000 is $15, which would be applied to the interest for the first month. The balance, $35, would be applied to the $1,000 principal to reduce it to $965. Good luck.